So as we all know, the stock market has fallen off a cliff in the past couple of weeks. The Dow Jones has been down around 27%. And so at this point, a lot of people are starting to ask, should I sell my stocks? Is this going to keep going lower? And are just generally confused on what to do. And so in this video, I'm going to give you 3 things that you can do that will allow you to not sell your stocks and still not lose money. The methods I'm about to show you will allow you to hedge your portfolio, which means that you're not selling stocks, but if the stock market does go down, you're not losing money. So I'm going to show you how to do that right now. First, I'll bring up the SPY. This is the S&P 500 ETF. And the first method on how to hedge your portfolio is to buy a put option. And a put option, you can think of a put option basically as insurance for your portfolio. So if you think about it in terms of insurance, let's say you buy a house and then you buy fire insurance for that house. When you buy fire insurance, what are you doing? You are paying a cost up front, and if your house doesn't catch on fire and everything goes perfectly, then the money you paid goes away and that money stays with the insurance company. However, if your house catches on fire and burns down, the insurance company will give you a payout to recuperate your losses. And this is the same idea with a put option. You can buy a put option, and if the stock market goes up, then that put option will become worthless. However, if the stock market keeps going down, that put option will become more valuable and will help balance out the losses with the stocks that you hold. So we can take a look at a concrete example. We can go over to the options tab right here. And so these are all different dates, and these are dates that the options expire. So you can think about this as when your insurance expires. So you can choose a date that you want to be insured through. For example, we can take a look at the April 17th, the put options that expire April 17th, which is right here. That's in 35 days. The options are on the right side. And now I'm not going to get super into how options work, but there's different strike prices. And what I usually do is buy a put 1 strike in the money. So up here, the price of the S&P 500 is 257. So I would buy, since I'm buying a put, I'd buy the closest one above that amount. And that is the $258 put. Now, so options work just like stocks. The bid price is $21, the ask price is $21.14, and the last option sold was $21. It's constantly changing. But the thing with options is that one options contract represents 100 shares. So you take this amount, the price amount of this option, and multiply it by 100. That's what you'd be paying. So in this case, you'd be paying around $2,100 for this option. And so the great thing about options is you can use a model to see how much they'll be worth depending on how much the stock market goes down. So we can analyze this. And so here we go. Here is a chart of the April 17th $258 put option. And what we have here is a graph. And so we have 2 lines. The purple line is the price of the option today, and the green line is the price of the option on April 17th when it expires. And so this red line right here is the break-even price. So if the S&P 500 goes to $257 around, then you will break even on your option. However, what we see is the line is sloping down. So as the price, if the price of the S&P 500 goes down, the option becomes worth more. And so we can use an example. Right now, the S&P 500 is at 258. If we say if the S&P 500 fell to $240 in the next couple of days, we could see that the option would be worth around $9,500. And remember that you paid $2,100 for the option. Now you can calculate this with your own situation. Let's say you have a $100,000 portfolio and you want to buy one of these put options for $2,100. So that would be 2.1% of your portfolio you're putting towards this option. And if we see that S&P 500 fall to $240, if we say that the S&P 500 will fall to 240, so if you just had a portfolio of all stocks, your portfolio would fall around 7%. So you'd be left with around $93,000. However, you can calculate what would happen if you bought this option and then that happened. So the stocks you owned would still lose 7%. So that would be 7% times 97,900. So you would lose around $7,000. But remember, you had that put option that you paid $2,100 for and is now worth, we can call it $9,700. So from that, you made, what is that? You made $7,600. So we can add that to this. And so what we can see is, even though the market fell 7%, with this put option, you actually made $683. And that's sort of the power of using put options as insurance, that you pay a small cost up front, but you're protected in the event of a large downturn. And the more the market drops, the more this option will become worth. So you're protected essentially no matter how far the market drops. And so a problem with these options is that they're expensive. The one I just showed you is around $2,100. And if someone only has a portfolio of, $20,000, it doesn't make sense to put 10% of your portfolio into this put option. So what you can do instead is put your money with an ETF that has the same effect as a put option. In other words, when the market goes down, the ETF will go up. And the ETF that I have in mind is the SDOW. It's the ticker SDOW. And basically what this is the inverse of the Dow Jones. And so as you can see, when the stock market crashes, this ETF goes up. At the top a couple of weeks ago, this ETF was at $33, and now it is sitting at around $65. So it's almost doubled in that period. And so how this ETF works is it does the opposite every day of the Dow Jones. So if today the Dow Jones falls 2%, this ETF will go up 2%. And you can play around with the numbers to make it work for your portfolio. Hedges like this shouldn't be too big of a position because, as you see, they go up drastically when the stock market falls. So depending on how much risk you want to take, you could make this anywhere from 1% to maybe 5% of your total portfolio if you're heavily invested in stocks. Now, the last thing you can do is buy bonds. The common thought is when stocks go down, bonds go up because they're considered safer. So the easiest way to buy bonds is with the TLT index, which is with a bond index, which is the ticker symbol TLT. And again, as you see, when the stock market goes down, bonds tend to go up. We can take a look at this here. So a few weeks ago, this bond index was at 143. Now it is at 155. This is a way to hedge your portfolio, but I don't recommend it for a few ways. First, as you've seen in the last couple of days, bonds have sold off along with stocks. So there's no guarantee that if stocks go down, bonds won't also go down. That's exactly what we've been seeing in the past couple of days. Secondly, I consider bonds to be in a bubble right now, with much of the world having negative yielding debt, which is just absurd. And the third reason is the price of this index will jump drastically depending on interest rates and actions the Federal Reserve takes with cutting rates or increasing rates. Now, the thought is currently that the Federal Reserve will continue cutting interest rates, in which case bond prices will go up, which would be good for this index. However, if in the future interest rates go back up, which in all likelihood they will at some point, then bond prices will fall. And so that's why I don't like using this method as much as the other two. However, it is still an option should you choose to go this way. So I hope you all found this video helpful. Again, I made this because a lot of people are considering selling their stocks, which may or may not be a good idea. I mean, it depends. But if you're someone that's scared of losing money and you don't want to sell your stocks, and you understand that selling your stocks at this point in time is probably not a good idea, these are some steps you can take to preserve your capital and keep your portfolio value consistent even if the stock market goes down. Thank you for watching this video. If you have any questions, be sure to leave a comment and I'll get back to you. And I will see you on the next video. Bye bye.